This banking crisis is only in the first inning, and this is why. Now, there's been lots of talk about the banking crisis and if the Fed and the governments have fixed the problem and it's over. But after doing some digging around and looking at the debt, the loans, and the balance sheets, I've uncovered something much bigger and deeper than most people realize. And this could crash the entire system. And you need to be watching this right now. So in this video, I'm going to break down what this big hole is, what the risk is in the banking sector that no one's talking about. We're going to take a look at how big this is, what damage has already occurred, what potential outcomes this could lead to, and what you need to be watching and doing right now. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because, man, almost everything you've learned is wrong. It's very difficult to understand what's going on because the financial system is so complex, but we can break this down. We can make it easy to understand, of course, make it actionable so you know what to do to navigate your way through this. All right, so let's dig in. Okay, the banking sector. Like I said, I've already done a few videos talking about the banking sector. We'll link to them down in the show notes down below, explaining the mechanics of what happened with the bank failures and what the Fed's doing to fix this situation. However, they haven't fixed it. As a matter of fact, as I said, I think the banking crisis is only in the first inning, and so it's hanging on by a thread right now. All right, there's other massive big problems that are happening and are about to erupt inside what the bank puts their money into, the other assets, and specifically, we're talking about the commercial real estate that the banks are holding. And this one, it's also the Fed's fault, except for this time, it maybe isn't entirely the Fed's fault. Now, to continue to understand this banking crisis, it's just beginning. You have to understand a little bit about how the banking system works. So, banks are capital allocators. They receive money from you and I, the customer, and then they invest that money into different things. Now, if the investments do poorly, then they have a hard time paying customer deposits back, especially if too many customers ask for the money back at the same time, which we saw in the last banking crash. But what do the banks typically invest in? Well, they buy securities. They also lend to people. They lend to businesses. They also invest into real estate and property developers, which brings us to the point that I want to talk about today. So you're probably already aware when the money supply increases, then things boom. When the money supply decreases, things bust. And that's exactly what's been happening. So the Fed is the one that causes this. That's why I say they're the arsonist and the firefighter. The Fed causes the money supply to expand, and then the Fed causes the money supply to shrink. And that's exactly what's happening to the banks right now as well. Now, if we look back at this chart, you can see that since 2006, you can see the weekly change in the small bank deposits, and you can see the ebbs and flows. But you can see that it stays somewhat in a consistent line. And this allows for the banks to plan for the long term. They know that they're in this range. They can invest. But you can see in 2020, the amount of deposits spiked from all that stimmy money that the Fed and the government's printed. Now, this led to bank balances swelling much larger than normal. And then what were they going to do with all that money? Well, they're going to lend it out and they're going to invest it, of course. But then what you can see happen is all the way on the far right, you can see the customers' bank balances started to be withdrawn. And not by just a little bit, but by the fastest and largest amount we've seen. Much larger and faster than even the 2008 great financial crash. And what do you think happens when the banks lose all those customer deposits? Well, they stop financing loans, such as new real estate. Now, this massive shift and slowdown where banks are not lending out money, they're not lending out money to real estate developers, is now creating a whole new set of problems. It's basically like whack-a-mole, right? It's like plugging holes in a dam, fixing one thing, but then more holes pop up somewhere else, and you just keep trying to fix problems and just keep causing more. And so, as we say, history doesn't always repeat, but it rhymes. And that's exactly what we're seeing. This time is not the too big to fail banks like we saw in 2008, but rather it's the small regional banks that are exposed to all of this. This time, the small regional banks they've taken the most exposure to commercial real estate. And they're the ones that are getting completely hammered and failing right now. Of the almost $3 trillion of total commercial real estate, Debt, it's the small banks that are holding 70% of that, which is way too much. Now, if you hold a large disproportionate amount of the risky debt, then of course you're going to get hit with a large disproportionate amount of damage in the event of mass defaults on the commercial real estate exposure and the loans. Now, to understand why this is all unraveling and how big this could get, we have to peek inside. Let's look under the hood and see exactly what's going on here. So, what happened, the COVID pandemic forced people to work from home. Now, these were businesses who thought that maybe they would never be able to work from home. They'd never be able to have their people working from home, but they were forced to. And when they were forced to, they found out that it actually wasn't that bad. And as a matter of fact, it actually somewhat worked. And so since then, office space has been going. It's been sitting vacant. And the vacancies are still rising even today. In fact, U.S. metro office space vacancy rates are almost 20% vacancy, which puts them at the highest proportion to total office space in the U.S. ever. That means 1/5 of all U.S. office space is vacant, which means no one's paying rent, which means no one's receiving rent. Now, if that sounds bad, that 1 out of 5 offices aren't paying rent, which of course it is, just wait, because as we say, there is more. And to understand that, you have to take a look back to the Fed. Now, their manipulation of the price of money, you see, the way the Fed moved the price of money down to zero and held it there for so long, of course, in order to encourage lending and borrowing, and of course, that's what happened. All those real estate developers, they took on massive amounts of loans at near zero rates. But now that the Fed raised rates with, as I like to say, reckless abandon, going on the fastest and steepest rate hike in history, it's all come crashing down. As a matter of fact, $92 billion of total commercial real estate has to be refinanced this year. And $317 billion of commercial real estate debt will have to be refinanced in the next 18 months. And what's the problem with that? Well, they took all those loans at near zero, and now they're going to be forced to refinance at much higher rates, which might actually be impossible. Now, even in a good market, this would be very difficult, if not almost impossible. But what about now that 1 out of 5 offices are empty and not paying rent? So real estate developers are going to be forced to make a very, very tough choice. Either one, sell the property, which most likely means at a massive loss, if of course they can cover that. If not, outright default and just let the banks take it back. And just to show you how big and acute this problem is, of the $162 billion in total commercial real estate debt that's maturing this year in 2023, $35 billion of it, 21% of it, is already past due. Now, the outstanding commercial real estate debt has an average debt service ratio of 1.25 times, which means it's already just barely covering the loan payments, let alone, all the other expenses of owning a building and all that. And what's the collateral for the 25% of commercial real estate debt? Well, it's the office buildings and the assets inside, which are, yes, of course, not worth what they're collateralized for. So now you know, prices are the equilibrium of supply and demand. So what do you think happens when you have a massive amount of office space being forced to be sold, either through fire sale or bank liquidations? You would guess it, right? Prices would come down. And they'd come down massively. So you have property owners failing to make payments, which then default, and then banks liquidate assets, which creates a violent feedback loop, a doom loop of selling vacant property. Now, to run through the numbers just one more time, there's $2.925, about $3 trillion of commercial real estate debt in a $20 trillion commercial real estate market. And this forced selling could cause a massive impairment in the market. When you see these defaults start to occur and the lender's debt assets become worthless. So now, just ask yourself, who are the big lenders here? Which banks are at risk? Well, as we started out with, it's the regional banks. A lot of people have been saying recently, the small local banks. In this case, it's the regional banks. They are the ones that are already experiencing the bank runs and failing. And they accounted for 27% of the new commercial real estate lending in 2022. Now, if you're catching on here, this could lead to a massive debt doom loop where, again, commercial real estate loans default, causing small bank failures, which leads to more tightening of lending, which leads to further commercial real estate loan defaults, which leads to more bank failures. And you get it. You rinse and repeat until we doom loop all the way down. And this isn't some maybe, one day far off scenario. This is happening right now. We see U.S. commercial real estate vacancies are sky high. The prices, they're already coming down. As a matter of fact, they're crashing. They're already down 5%. Office space has seen its third worst quarter of sales volume since the great financial crisis. We got JP Morgan estimating that $38 billion of commercial real estate debt is already distressed and at risk of default, which of course is leading to massive amounts of investors selling their commercial mortgage-backed securities. And that leads to the market plunging. In fact, we can see that private commercial-backed mortgage security deals have fallen by a massive, whopping 84.3% this year. And if nobody buys these commercial mortgage-backed securities, then banks don't make new mortgages, which leads to another doom loop. Now, have you seen the movie The Big Short? If you haven't, I highly recommend you watch it or read the book. And even if you have, I'd maybe even recommend that you go back and watch it again, just to kind of get caught back up on how this works. In that movie, we had traders betting against the mortgage-backed securities that the banks were holding back in the mid-2000s, and it's happening all over again. In fact, we can already see the traders are lining up and betting against the commercial real estate market. The BBB tranche of the CMBX, an index of commercial mortgage-backed securities, has sold off to 69 cents on the dollar. We have office REITs. They've already plunged 71% this year as investors are cutting their exposure to that. So as you can see, there's lots of danger hidden inside the debt and the credit markets. And this is why the banking crisis isn't over. In fact, it's probably just in the first inning. Now, this credit contraction is just getting started, and the doom loops are going to start kicking in. We can already see that commercial real estate is the first victim, but it's not going to be the last, because higher rates are finally seeping into financial markets, and eventually they'll seep into the real economy. Now, while the math is certain, the outcome isn't. As you already know, I say it all the time, there's no such thing as certainties in life. And so I expect the Fed to come out, and I expect them to come out swinging. I expect them to fire up the money printers, pull off some new magic trick, pull it out of their sleeve, which means, more inflation, more higher prices. But the question is, when will that happen? What happens between now and then? And that's anyone's guess, which is exactly why I practice a barbell approach with my own investments right now, which means I stack my assets on either side of a barbell. On one side, cash and cash-like equivalents. On the other side, I like commodities, I like gold, I like Bitcoin. And that's what I'm ready for any situation, because we don't know what's going to happen between now and then. I believe the future is certain. I believe we know that the government's going to print more money, but what happens between now and then? Be prepared, get some popcorn, sit back, and enjoy watching the show, I suppose. Let me know what you think. Leave me a comment down below. Of course, as always, give me a thumbs up if you like the video. If you don't, you can give me a thumbs down, but at least tell me why in the comments down below. And that's what I got. All right, to your success. I'm out.